I'd say Biden has effectively fired 5 torpedoes at his own petrodollar now. So the very primacy of the US petrodollar, I think, has been called into question.
Monaco 64, home of alternative economics and contrarian views. Today is June 1st, and I'm interviewing Tim Price of Price Value Partners. I used to read Tim's articles in Money Week. His background is similar to mine in the city of London. He was a bond salesman. I did the same thing more with the futures market. And Tim is a really interesting person to follow, I would say, on Twitter. And his views are pretty much like mine. So it's great to have you on, Tim.
Thank you, Monaco. Fool's minds run in the same gutter, evidently.
That's a good one. I like that. Yeah, and I mean, we've been in contact for a few years now on Twitter, and we've never gotten around to do an interview. So, and actually, I think it's a really good time to do so, especially with what's happening in the bond markets. I know the U.S. Treasury market is the one that most people follow, but being in the UK, I've noticed recently that the UK 10-year yield, the gilt yield, is broken out. I was talking about it yesterday. I tweeted something out. It seemed to be a big resistance around 2, and now it's just blown through it. It's around 215. So maybe we can start with that.
Sure. I mean, we're in the process. My colleagues and I are in the process of preparing presentations for institutional clients, institutional and private clients, and basically the very first page we've got is chart of interest rates in the historical context, and this is basically an amalgam of interest rates. So I suspect it's a blend of UK, US, and Greek, Assyrian, Persian, Egyptian, God knows what, going back to, I mean, the figures are from the Bank of England, amongst others, and they go back to 3000 BC. So that clearly predates both the gilt market and the US Treasury market. But it's assuming it's a melange of sort of benchmark rates across a variety of markets. The long story short, they've never been this low in all of recorded history. Or I should say they've never been this low, but they're going higher. So as you say, we both have a background in the bond market, in the credit market. I think this is perhaps the biggest market secret hiding in plain sight. That firstly, the bond market is an underappreciated market. In other words, if you follow financial media, which I wouldn't encourage anybody to do, then the stock market gets all the limelight. But it's the bond market that really matters, because at least in conventional market analysis, the bond market or the government bond market, particularly the US and the UK government bond markets, are the so-called risk-free rate off which everything else is priced. So where the bond market goes ultimately has a big say in the medium term over where stocks go, where property markets go, where everything goes. So they're like ground zero. And as you've said, these markets are starting, the yields in these markets are starting to, I wouldn't say drift higher, they're starting to spike higher. And that has implications to the extent that anybody alive who's only realistic, anybody in a dealing room, anybody in a portfolio management office has only ever benefited from declining interest rates. Well, that 40-year game is now over.
Yes, and Tim, before we go further, could you just tell the viewers quickly your background and what you're doing right now?
Sure. So as you say, I started my career as a bond salesman. So I was a generalist bond salesman working for a variety of firms, Japanese banks, French banks, and latterly American banks. I worked for Merrill Lynch in the late 90s and then moved over into private client business there. Then I've worked for a variety of firms, but I started my own business in 2014, Price Value Partners, which is an asset management firm for private clients. And I never intended to come into the city. So I read English university and thoroughly intended to become either a journalist or an advertising copywriter or something along those lines. Fate had other ideas. So I graduated in 91 and entered the job market then. That was a recession year. And in a fluke of history that could best be described as bizarre, my first job turned out to be bond salesman for a Japanese bank. And I sort of stuck around. and quite like that. The reason I give you this sort of long diatribe is because although I never studied economics conventionally, I feel that having worked in the bond market gave me a reasonable grounding in the sort of global macro stuff, things like interest rates, inflation, currencies, GDP, all this, or the sort of the middle and back office of the financial markets, if you like. And the beauty of the bond market, if it has a beauty, is that it gives you a very good grounding in basic economics, things like supply and demand, and to a lesser extent, perhaps greed and fear. And so the 10 years working as a bond salesman gave me a loose awareness of the financial world that made up for my lack of experience in conventional economic training.
It was probably a good thing you didn't study economics at university.
Well, you say that. I mean, one of the people I keep continually gently mock is my older brother. So my older brother is effectively the reason why I started out, why I applied to city firms in the first place, because my brother read economics at Cambridge, which is, as any good market skeptic knows, is the ground zero for sort of Keynesian economics, which I would say is perhaps the most deadly thing on the planet other than Ebola. And so I gently tease him every so often and say, just out of interest, how much of the Cambridge economics course was devoted to the Austrian school or classical economics school? And of course, the answer comes back zero. Whereas so my awareness of sort of matters economic and financial comes from practical experience of working in the capital markets. But in as much as I have any sympathy for a more academic form of economics, it's all on the side of the classical economists or the Austrian school, people like Ludwig von Mises and Friedrich Hayek. And I think the relevance of these people, for anyone that's not familiar with this kind of the Mises world, Mises was someone who was a literal Austrian, and that I think he was actively practicing in Vienna. He had first-hand experience of the Weimar hyperinflation, for example. And the reason I mentioned this, I think it has an acute relevance today because Mises literally wrote the book on at least one arm of classical economics, and that magnum opus is called Human Action. And the reason this is relevant is because a lot of Keynesian type economics is very much model based. It's very mathematical. It's basically physics envy. So it was pulled together basically by ripping off elements of physics and then misapplying them to the world of economics. Whereas the Austrian perspective, or the so-called Austrian perspective, is much more about how can you possibly have a model of the world when the economy is actually us? So hence the title Human Action. And the reason I think Mises is doubly relevant today is that Mises coined this phrase known as the crack-up boom. And the crack-up boom is what happens when the average man or woman in the street suddenly twigs that their own currency is being printed to destruction at such a rate that they suddenly realize the only way they can possibly save anything in their saved capital is by converting that fiat money, that paper money, into something harder, a better store of value. And that could be property, it could be wine, it could be common stocks, it could be any number of things, but it's not going to be paper promises issued by a government. And I think we happen to be at the start, or perhaps there are even some months into that crack-up boom happening. So you look at the inflation rates pretty much anywhere in the world. And this is another insight that people don't necessarily get unless they work in the city, or possibly don't even get, even if they have worked in the city, which is I'm going to cite Milton Friedman now, which is inflation is always and everywhere a monetary phenomenon. So to blame current high inflation on the Russian spat with Ukraine is complete nonsense. The reason we have high pricing, there's maybe a tiny element, but the vast majority of the inflation that we're now seeing in pretty much everything is less to do with, say, Russian-Ukraine hostilities, and almost everything to do with the fact that of all of the dollars that have ever existed, 40% of them have been printed in the last 2 years.
Yes, I listened to one of your recent interviews on YouTube, and you spoke about how very few people in the city or on Wall Street actually know what money is. Could you elaborate on that?
Yeah, the classic definition of money is that it does three things. It's a unit of account. In other words, you can price things in it. It's a medium of exchange. In other words, you can exchange things for it without having to resort to barter. and it's a store of value. It's something that retains its purchasing power over time. Clearly, we have still the unit of account aspect, but I'd argue the other two, the medium of exchange, and particularly the store of value, that went out the window some time ago, if we've ever indeed had it. So we have a monetary system that is being thoroughly debauched even as we speak. And one thing I've learned about money or moneyness over the years is that, well, this is not an acute observation. It's not a particularly abstract one. It's a fairly straightforward one, which is over time. Well, let's go back a bit. Let's go back to 1971. So in 1971, prior to the so-called Nixon gold shock, we had a monetary system that was broadly backed by gold. So the US dollar was effectively the reserve currency of the world, and the dollar was itself backed by gold reserves. And buckling under the twin pressure of the cost of the Vietnam War and the sort of great welfare system of the US at the time, the US dollar was coming under tremendous pressure. And foreign central banks, most notably the French, were queuing up basically to convert their dollars for gold. So the US was hemorrhaging gold. So Nixon, to forestall the inevitable, said, okay. And I think during an episode of the cowboy TV series Bonanza, went on TV and said, okay, everybody, we're now suspending temporarily, i.e. permanently, we're now suspending convertibility of the dollar into gold. And from that moment onwards, from that moment until now, the dollar has not been backed by anything except the full faith and credit of the US economy or US government. And in turn, every other floating currency has been basically priced off dollars or trades off dollars. So there's been a sort of freely floating currency world, but not backed by anything tangible. And what that's meant is that you had, if you give a politician an inch, you'll take a mile. So if you give these guys a latitude to print money to destruction, they will ultimately print the money to destruction. So we've had a monetary system that's not been backed by anything, whereas previously we have at least had some form of hard asset backing behind paper money to stop politicians going out of control. When you have politicians spending like drunken sailors, ultimately the currency collapses. And I think we're at the perhaps middle stages of a global monetary regime change. Let's put it that way.
Yes, back in like 1923, many people don't realize that the German government, they started printing and borrowing like in 1914. And it was only, I think, in 1922 that inflation really started taking off. So it took about 8 years. So where do you think we are in terms of how, I know it's impossible to predict when it's going to start, but we're still hearing a lot of people, mainstream economics, Treasury secretaries, central bankers, they were saying last year it was going to be transitory. They were wrong. Now they've got this silly break-even rate, inflation expectations. They're saying, oh, in 2-3 years, we're going to be back down to 2 or 3%. But in the meantime, I did a video today talking about how the average U.S. Treasury investor is losing almost 7% in real terms. So, what do you see inflation, in terms of, do you think these people are going to be right? And how do you think it's going to work out?
Well, I noticed on Bloomberg earlier today that Janet Yellen was issuing a mea culpa that she'd got this thing hopelessly wrong. So credit to her for at least sort of coming good later in the day, sometime late in the day after the fact. These guys haven't got a clue, and I think most people in the city would grudgingly or willingly accept that central bankers have never really had much of a clue, but they're being shown for the clowns they are now. So as Warren Buffett said, it's only when the tide goes out you see who's been swimming naked. Well, the reality is that, and there's a rather unseemly image for which I apologize for imprinting on people's minds, but we're now seeing a whole bunch of central bankers, and none of them are wearing any swimming trunks. So it's a very grisly image indeed to conjure with, which I now wish I'd very much not conjured up in the first place.
Yeah, I wouldn't like to see Agustin Karsten at the BI.
Oh my God! Oh dear, yeah.
Yeah. Could you talk about this idea of the Black Swan monetary event? Maybe that's been triggered with what's happened in the Ukraine and what the U.S. and the West have done to Russia.
Yeah, I mean, the Ukraine thing really is fascinating. So I forget which famous Russian it was who said this, or famous politician who said there are years when nothing happens, or there are decades when nothing happens, and then there are weeks when decades happen. And we're living through one of those sort of incident-rich environments as we speak. So the Russian incursion or invasion of Ukraine triggered a fairly immediate policy response by the Biden administration. One of the aspects of which was to, I would say, somewhat arbitrarily seize Russian foreign reserves, including gold, or rather, including their dollar holdings held abroad. And a friend of mine who works in the hedge fund industry pointed out, this is only probably about 6-8 weeks ago, pointed out that even at the height of the Second World War, the Bank for International Settlements, the BIS, the so-called central bank for central banks, even at the height of the Second World War, the BIS respected Nazi foreign exchange reserves and foreign assets, full stop. So what the Biden administration has done in the context of Ukraine goes way further than what happened during a hot war of some 6 years duration, with the whole world fighting each other. So it's a quite extraordinary event, the magnitude of which cannot really be overstated. And as a result of, I would say, again, I'd use that word somewhat arbitrarily, seizing Russian assets, notably dollar holdings, then one of the side effects of that initiative has been that Russia has effectively been obligated to make its ruble, the Russian ruble, gold backed, to ensure that it has some monetary solidity. Because clearly, in the early stage of sanctions, the ruble lost a lot of value very, very quickly. But it's made all of those losses back and then some. And then, if you extrapolate or just continue taking out the dots from what this all means, what that's then meant is, firstly, that Russia has moved closer into economic orbit around China because they're more closely aligned in political terms, and secondly, it's meant that the mighty US petrodollar system that we're all used to from the 1970s, again, the going back to the sort of the 70s experience, the great bargain, the great trade-off that was agreed in the 70s between the US and Saudi Arabia was that the US would offer military protection to the Saudis in exchange for the Saudis only accepting dollars in return for their oil. Now that Biden's blundered onto the scene and effectively behaved like a clown running over a minefield, we've had these sort of political impacts, namely that Russia's moved closer towards the axis of China, but equally the primacy of the US petrodollar system has now been, I'd say Biden has effectively fired 5 torpedoes at his own petrodollar now. So the very primacy of the US petrodollar, I think, has been called into question. In other words, the monetary regime that we've all been used to for the last 40, 50 years is crumbling before our eyes. It's happening in real time.
Yes, and even prior to the Ukraine crisis or war, people were already kind of trying to move away from the dollar because the Americans were using it as a sanctions weapon. And I think it's probably also scared a lot of other countries who have big reserves.
I mean, something similar that's happened was in relation to, you may regard it as a trivial example. I don't think it is, but you saw what happened in Canada when the Trudeau administration suddenly started, again, I'd use this word arbitrarily, effectively freezing people's bank accounts just because they had the temerity to back the truckers in the trucking dispute. We're seeing quite incredible political overreactions to events in the world, and you think leaves you scratching your head. How on earth can politicians be this dumb? But I suppose maybe I'm the naive one for thinking that politicians have ever been anything other than grotesquely dumb.
Yes, and I think it's also a symptom of what happens during a hyperinflation or crack-up boom. The whole societal structure melts down, and everything
just gets unmoored and just starts bobbing about in the current.
That's right. And just before we go into another topic, as for the BIS, I've got the book "The Tower of Basel" by Adam Libor. And in 1938, Germany invaded Czechoslovakia, and the BIS and the Bank of England allowed the German government to take over Czechoslovakia's gold with the BIS. So yes, you're right. And they kept I think they had the president of the Reichsbank was still doing business at the BIS throughout the war. The president of the Banque de France. It's quite amazing what's happened now. Like you said, it's a truly black
unprecedented, utterly unprecedented politics at the moment.
Yeah. Could we look into UK pensions? Because most people, I'm not sure, you probably know more than I, and that's why I wanted to speak to you as well. Could you talk about like the different pensions there are, and how some pensions, like defined benefit pensions, they have to invest a lot into bonds, and what repercussions that will have, especially that now that we're going into what looks like a long-term bear market in bonds?
Sure. So essentially in the UK, we have what are known as DB, defined benefit, and DC, defined contribution schemes. And as far as I'm aware, the key distinction between the two is that if you're on a defined benefit scheme, which are now extremely rare and most of them have closed, you get, the clue is in the title, you get a defined benefit, or you get a specific amount that's basically ring fenced and guaranteed. So that effectively becomes the responsibility of the sponsor to make those payments, irrespective of effectively what's of the position of the pension fund or the position of the individual pensioner. Whereas under a defined contribution scheme, that basically means that a set amount is invested by a combination of the sponsor and the underlying pensioner every period, every year or whatever. But the actual return is going to be in the lap of the gods in terms of what the market return actually is. The way pension schemes work is, in this very heavily regulated environment, the regulator deems that the most appropriate asset for a pension fund is a liability matching investment. And for liability matching investment, read government bond, which might be a fixed coupon bond, or it might be an index linked government bond. But either way, it's government paper. And the problem with having an exposure to a government paper now is it's basically almost completely worthless in terms of its real value. That the yields on offer in the so-called gilt market, the UK government bond market, are so low that they are hopelessly below the real rate of inflation. So this is ultimately going to be a one-way ticket to the poorhouse. So for the last 40 years, it's been a great train to ride because interest rates have come lower, bond yields have gone lower, which means that bond prices have gone higher. So bonds have been, including government bonds, have been a great investment for the last 4 decades. The trouble is that investment managers and pension fund managers as well tend to conduct their policy looking out of the rearview mirror. So most pension funds are heavily invested, and I use the term invested with a sense of irony. They're invested in government bonds, probably more than any other single asset, because that's deemed to be the most appropriate liability matching tool available to them. But that doesn't take into account the fact that government bond prices can go down as well as up. Yields can go up as well as down. And if, as I think possibly we both will tend to agree, the overall bond market, what's the most super tanker, if the super tanker that is the world bond market is finally starting to turn direction from a 40-year bull market to a question mark year bear market, yields and rates are going up rather than down, all bets are off. But any investment, including a pension fund that is heavily allocated to fixed income instruments, is, let's say, in danger of perhaps the risk of incurring perhaps catastrophic capital loss.
And how big is a proportion of, let's say, all pension fund assets in the UK? How much are they exposed to the bond market?
The honest answer is I don't know, but I can tell you that in the private client arena, which is the world in which I operate, so we deal with private clients, albeit on a bespoke basis. So we don't have a one size fits all approach. We try and be more flexible than that because people have different risk appetites and different pots and different time horizons and all this stuff. So people are different. But I can tell you that in the private client arena generally, the strategy that a lot of so-called IFAs, independent financial advisors, tend even now to use is basically what's called the 60-40 portfolio, where roughly 60% of the portfolio is allocated to stocks and roughly 40% is allocated to bonds. And it gets worse than that if you consider that the bond market is now an accident waiting to happen, that the bond market is now a bug in search of a windshield, that the 60% that's allocated to stocks will be heavily benchmarked. They'll be benchmarked in both instances. That the equity piece will be benchmarked to an equity benchmark, and the bond piece will be benchmarked to a bond benchmark. And I'll come back to the bond side because it's an important point that I'd like to re-emphasize in a few seconds' time. Benchmarking is a complete waste of time for everybody involved, and I'm amazed at how it ever managed to get off the ground as a concept. So let's say, for the sake of argument, you're managing a global equity portfolio. For the sake of argument, that means basically, if you're tracking it as a global manager, if you're tracking the global market, you effectively are actually tracking the MSCI Global Equity Index. And right now, something like 70% of the MSCI Global Equity world is allocated to the US, which means that whether you like the US stock market or you hate it with a passion, you have to have 70% of your money invested in it regardless. That does not make sense. The same lack of logic holds in the bond world, which means that the typical bond benchmark will be something like the JP Morgan Global Government Bond Index. And therefore, anybody with a bond portfolio, the chances are, if it's a global mandate, then they'll effectively have the same thing. They'll be heavily skewed towards owning what's in the JP Morgan Global Bond Index. Now, have a think just for a second about what the implications of that allocation. If you're looking at a bond index, that bond index will give the biggest overweight to the most heavily indebted country. Where's the logic in that? You're effectively saying, we want to have the largest exposure to the worst credit risk. That's effectively what it amounts to. So this is the reason why I think that benchmarking per se is nonsense on stilts. And how it ever got off the ground beats me, but then there is a great deal of ruin in the market.
How do you think central banks are going to go forward? I mean, right now they're acting relatively hawkish, even though that word is, I think, really doesn't mean much in this day and age.
I would say they're more likely to be deerish, as in they're like deer trapped in the headlights. So I've never been a fan of central bankers. And I think these guys now have the most difficult job in the world, which is they have to try and navigate, have to try and gently manage the transition for interest rates from low to higher. Let's not say high, let's just say higher. Firstly, I don't think anybody believes the official inflation rate. So the inflation rates can be wildly discounted. Then they're not an accurate reflection of what's really happening to prices on the ground. So I think the Eurozone inflation print earlier today, or I saw it quoted on Bloomberg, was something like 8%, 8.1%, something of that order. It's probably twice that in reality. Real inflation, i.e. genuine, honest inflation in the UK is probably double digits too, and it's probably in double digits in the States. So you have to ask yourself, how on earth? I mean, central banks only have one job, which is basically keep inflation low. And that's maybe an impossible job, but nevertheless, that's the job description: keep inflation low. I mean, the Fed has a twin mandate, which is also try and guarantee full employment, and that's a separate argument. But let's just keep to the inflation thesis, the inflation story. How can you keep inflation at the 2% target rate when the inflation you're owning up to is nearer to 10%, and your monetary policy rate is nearer 0.5% or 1%? The answer is you can't. It's impossible. So these guys have the most impossible objective, which is to try. All they can really do is sort of moral suasion. It's so-called, George, or all they can attempt to do is try and talk the market down, because they can't realistically raise rates in actuality very much, if at all. If they raise rates to anything like the level required to have a proper chance of actually genuinely reducing inflation, they would crash the market. They would crash the bond market. They would crash the stock market. They would crash the property market. So it's not going to happen. So they have an impossible objective, and they have, grotesquely blunt tools by which they can try and achieve that objective. what I hope in the fullness of time is what happens is that the very concept of central banks gets destroyed, because they are certainly no good for the man in the street. The central bank is not the friend of the average voter. The central bank is only a friend of government, because the central banker effectively is an economic agent of the government.
Do you think they could try to restart QE in order to keep bond yields down? And what would be the consequence of that for currencies?
So very good question. So this is my thinking on the QE side. If the economies, I should say, start to look like they're going to tip in towards recession, which I think is pretty much a done deal now. I think that thing is baked in. Then I think we probably will see the resumption of QE, and we may well see some form of yield curve suppression. So they will try and explicitly cap interest rates, the market set interest rates, as well as the policy rates at the front end of the yield curve. Were that to happen, then I think that the so-called trading community, or if you like, the bond market vigilantes, being unable to express a proper free market price-based opinion on bond prices, they would then migrate to the one market that is too big for even central banks to kick around, and that is the currency market. And what I then think would happen is you'll see an attack on all fiat currencies from the periphery in. That attack will ultimately include the dollar, but the dollar will probably be the last fiat standing, or one of the last fiat currencies standing. But in the interim, all of the intervening currencies out there get demolished. So pretty much whatever you think of, or certainly in my world, whatever I think may conceivably happen from a monetary policy front, to me, all roads ultimately lead back to gold being the preeminent currency du jour, because gold is, if you can even call gold a currency, which technically, of course, it isn't, it's a commodity, but it's also been a form of moneyness, a form of store of value for thousands of years. Then if you think that they're going to try and suppress yields in the bond market, and there is a speculative attack on currencies, then the one currency that can't be printed is gold. So you want to own gold.
Yes, I've noticed the price of gold in Japanese yen this year made an all-time high, and BOJ is printing like mad. So
one circumstance that will be very interesting, and I'm channeling Russell Napier, the strategist Russell Napier, because I know he said this on numerous occasions in the past. The most interesting development will be when gold is basically trading at record levels in every currency. And it's probably close to record highs in most currencies, but it'll be when it's doing that in every currency, including the dollar, that you really have to start paying attention and thinking, do you really want to own this stuff? Do you really want to own paper currency in any form, or government promises in any form? Or should you be primarily focused on what we would call real assets, hard assets? And I think the answer to that question is, well, yes, you probably do want to own them, and you probably want to own them sooner rather than later.
So could we go through like your investment strategy that you're looking at these days?
By all means. So we operate in the private client world. So our objective is quite straightforward to express, maybe not straightforward to deliver, but it's straightforward to express, which is, we've been basically gifted the sacred assets, the irreplaceable assets of a number of private client investors, and our hope and expectations that we can try and shepherd those assets through whatever the market can throw at us over the next X months and years, indefinitely into the future. And so the reason we adopt this approach is in large part informed by a book that I came across in the late 90s called Against the Gods by Peter L. Bernstein. And Against the Gods is effectively a history of risk. It's a fantastic book for anyone that's sort of market geekily attuned, as I clearly am. And within that book, which is a history of risk, there's a quote from a guy called Daniel Bernoulli. And Daniel Bernoulli has a good claim to be the world's first behavioral economist. He was a sort of Renaissance man, and anyone who studied physics will be familiar with something called the Bernoulli principle, which is about fluid dynamics. But Bernoulli also addressed the issue of managing money. And he said the following thing: if you are managing money for wealthy investors, quote, the practical utility of any gain in portfolio value inversely relates to the size of the portfolio, unquote. Or in even plainer English, if you're managing money for wealthy investors, just don't lose it, because they've got the money to begin with. They clearly will want some form of economic return on top, in other words, to compensate them for inflation, but they are unlikely to want to return. They are unlikely to want to to take so much risk in pursuit of a return that they jeopardize the starting value of the pot. So in plain English, just don't lose it. So that's very much our objective too. So we're trying to preserve and grow the capital of our clients in real terms, which may sound easy in theory, but in reality, in a market like this, it's extremely difficult. And with that objective in mind, that's going to go absolute return objective and capital preservation objective simultaneously. The way we're attempting to deliver that at the moment is as follows. The sort of general asset allocation of our clients' portfolios is at the moment approximately 40% allocated to what we call value stocks. And what I mean by value is basically high quality but cheap stock, listed securities, the sort of stocks that Ben Graham would have been proud to own back in the 40s and 50s and 60s and 70s. And Ben Graham, for anyone that's unfamiliar with the name, is the guy that taught Warren Buffett himself at Columbia Business School. And Buffett's the only one of his students he ever gave an A to. So Ben Graham is basically the godfather of value investing. And he wrote the literal Bible on value investing called, what else is it called? I've forgotten now. It's the Intelligent Investor, which I think was published in 1949. And that still gives you the principles of value investing, which is basically A, don't buy rubbish, and B, when you found good stuff, just don't overpay for it. It's that straightforward as a concept. So that's value investing as we understand it. So typically 40% of our client portfolios will be allocated to globally unconstrained value stocks. Another 20% there or thereabouts. These figures are subject to individual client taste and other requirements as well, other objectives that they may have, and risk appetite and investment time horizon, all that kind of stuff. But in essence, typically 20% will be allocated to a type of momentum strategy known as systematic trend following. In the States, this is known as managed futures or commodity trading advisors, CTAs. But in essence, a trend following approach is simply a price momentum approach, whereby the managers who are pursuing this activity are simply trying to hitch rides on strongly trending markets. Those markets could be hard commodities, soft commodities, interest rates, currencies, pretty much anything, typically through futures markets because they're the most deep liquid markets in the world. And we use them, A, because they have a very good track record over the medium term historically, and B, because they are completely uncorrelated to the stock and bond markets. So whatever their future returns are going to be, we can state with a high degree of confidence that they're going to be completely unlinked to the return available from stocks and bonds, which is what we want in a diversified portfolio. And then the third allocation, another typically right now, roughly 40% again, will be allocated to what we call real assets. And our definition of real assets for our client portfolios is again listed stocks, but in our world, and value stocks as well, but it's stocks that derive their revenues, their earnings from the commodities sector. So that could be precious metals, it could be copper, zinc, whatever. But we're basically looking for some form, hopefully, of inflation hedging from that part of the portfolio. So it's a mixture of value stocks, trend following funds, and real assets.
Yeah, that's great. Just wanted to ask you as well, because of what happened in 2008 with counterparty risk, is that something that keeps you awake at night, or do you think the central banks will patch over the banks and keep things going?
It's a very good question. The way we tend to look at, let's say the world of banking counterparty risks is that if any, let's say main high street, main street, mainstream name were in danger, I mean from a sort of banking perspective, so a high street name in banks, if any bank were deemed to be in danger, they simply print money to bail them out. So it seems highly unlikely that they do anything other than what they've done historically. I mean, counterparty risk is always a live issue, but given that we know what their playbook is, I don't think it may well be a problem for the smaller names that may not yet get bailed out, but for the larger players, you have to kind of assume they'll be made good one way or another.
Great, Tim. Do you have some last words for the viewers, and maybe you can tell the viewers where they can find you as well?
Oh, that's very kind. So you can find me. You can find our commentary and a bit about our investment process at pricevaluepartners.com, our website. And you can find me, if you dare, on Twitter at my handle is @TimFPrice. And last words would probably be I love my cheesy quote. So the cheesy quote I would leave with you which is going to sound a bit somber, but it's meant somewhat ironically, is from Lily Tomlin. Things are going to get a lot worse before they get worse.
Okay. Thank you very much, Tim. And hopefully we'll speak again soon.
Thank you very much. And thanks for having me on.
You're welcome.